So let's go through some scenarios on practice just to get some idea of how you can get yourself into trouble and how you avoid it. So, tax return preparer prepares an income tax return. There's $50,000 in gross income from consulting business on a Schedule C. There's $35,000 in deductible expenses. So, the taxpayer made $15,000. Preparer delivers the unextended tax return on April 14th of the year following the income year to the taxpayer's home. So he's dropping it off. The client lives in a 5,000 square foot home in an affluent suburb. There's a late model Jaguar sitting in the driveway. The preparer had never been to the taxpayer's house before delivering the room. How might OPR handle this situation? Is this a situation where 10.22 could come into play? Well, folks, you have a duty of due diligence. And that means that you try to assure the accuracy of return. But you're entitled to rely upon your client's representations to you until facts become known to you that are inconsistent. Then you're required to do follow-up. You can't just deliver this return, because how does this guy afford to pay for a luxury home on $15,000 a year? How does he afford to have an expensive vehicle in the driveway? Now, the follow-up before you could deliver this return would be to call the taxpayer and say, "How you doing this?" Now, the taxpayer might answer, "Well, I inherited $1 million from my Aunt Sally last year, and I bought the home and the Jaguar." Now, if that's provable, you can go ahead and deliver this return to the taxpayer. But given the fact that before you presented this return to the taxpayer, you discovered that he was living a lavish lifestyle, you can't just ignore that. You can't do this see no evil thing. So I've had situations where practitioners were under discipline because they ignored apparent facts. I had a practitioner from downstate Illinois that was disciplined a few years ago, and he was preparing a return every year in a town of about 1,500 people for the nicest restaurant in town. It was the place that if you wanted a nice dinner in that small town, you went to. It was the fanciest place in town. It was the most popular place in town. It had a breakfast trade, it had a luncheon trade, and then in the evenings it was a white tablecloth place to have nice dinners at a higher level. But every year for the past 10 years, that practitioner prepared a return showing a loss for that business. The restaurant was just down the road. He frequented that restaurant. He could see the level of clientele and number of people at it. He in turn had been there and had to wait in line for dinner or make reservations. And when the IRS audited the taxpayer and found that they had underreported thousands of dollars in income, after completion of that audit and assessment of very large liabilities against the restaurant for underreported income, the next step of the revenue agent was to come back and say to the practitioner, "I'm asserting a preparer penalty against you because you didn't assert due diligence. You should have known. You should have asked more questions. You could not blindly watch this." So, what must you tell your client? Now, when 10.321 says that if you gain knowledge that your client has made an omission on a tax return, you're required to tell them. So, let's talk about that a little bit. You were reviewing a tax return from last year for taxpayers come to you to do his tax return for 2017 in this case. You're looking over the 16 return and you see substantial errors by the prior preparer. you're required to tell the taxpayer of the errors, the ramifications of his failure to correct it, that he could be audited, or if it's very serious, he might be prosecuted, and that what it would cost him if he corrected it. And essentially the answer is, if you correct it, you will have to pay the tax and interest. But you are required to notify him. Now, what if, in fact, you're looking at that 16 return that you've prepared when you're preparing now the 2017 return, and you have the oh my God moment? Well, you still have a duty to tell your client that there's a mistake on a return. And the oh my God moment could be, you look it over and you see that you missed a $20,000 1099 when you did the Schedule B. It was just the rush of filing season. Oh my God, there's 10 1099s there. I only put 9 on Schedule B. I don't know how I missed it. You're still required to tell the taxpayer that there's a screw up, that there's an omission on the return. If they don't correct it, they might be audited, and if they do, they'll suffer penalties. And then you go forward, and if the taxpayer allows you, you prepare the return. But you have a duty of telling them. My recommendation is, in both instances, it's usually best to send the client an email or write them so you have some record that you told them. 10.22 is the diligence as to accuracy, which came up under the scenario we just discussed. And again, you can accept your client's word, but as soon as facts inconsistent with what they've told you appears, then you have to do follow-ups to find out why they can get by on the amount of income if they're doing a lavish lifestyle, or if they claim a huge deduction. You have a duty to check and see why that case is occurring. If the client has been normally donating $1,000 a year to his church every year, and suddenly he shows up and says, I gave $50,000, you normally would rely upon him that he had a written statement from the church. In that case, you probably should follow up. And now the conflicts of interest under 10.29 in this one. Well, if you had given this taxpayer the return, you might be subject to discipline. And your only way out is to say, I trusted my client. So the client's way out is to say, I relied on my practitioner to do a good job. So when a client lies to you and you accept it, you have a potential conflict of interest. And if you accept it when you have inconsistent facts, you have the danger that you'll have a 10.22 disciplinary action against you. So conflicting interest is under 10.29. We did a lot on that before, so I'm going to stop on that. Let's go to scenario number 2. ABC Security Inc. has had financial problems as a result of economic downturn. It owes 3/4 of unpaid withholding taxes, totaling $150,000 to the IRS. It's received 3 notices of intent to levy from the IRS and has not responded to those letters. On March 15, 2015, the owner of ABC Service, George Jones, engages you to represent the company. At the time of your engagement, the client provides you with a copy of a notice of levy on Last National Bank, which was served by the IRS 2 weeks prior to your engagement. So we know that they're taking the client's money from their bank account at the moment they arrive in your office. They ignored all the IRS notices. Bad things are happening to them. Let's continue the scenario. Your client tells you that all of the company funds are in the bank account and that the approximate balance at the time of the levy was $20,000. So they grabbed all $20,000 because he had $150,000 liability. Jones states that he cannot make payroll unless he can scare these funds back. So obviously he wants you to beg the IRS to return and release that levy. Jones also states he's about to receive a large payment from an account receivable in the amount of $50,000. He asked if it would be wise to put the money in the same bank account has been levied by the IRS, or should he open a new bank account in a different bank so that the IRS might not be able to levy it? What are your problems? May you advise the IRS to open a new bank account so that the newly acquired funds in the IRS account receivable will not be easily levied by the IRS. If you advise that of your client, you are violating 10.51 of Circular 230. That is disreputable conduct. You can't advise clients to hide their money from the IRS when you know levies are coming. Now, if the taxpayer asks you, can the IRS levy my account again? You can answer yes. And if he asks you, and if I chose to have another account, what could happen? And you say, I can't advise you to open another account. So if you don't take those steps, you could have a problem. Now, may you take the engagement with respect to the already levied funds, and what courses of action may you take on his behalf? You can go in and beg the IRS, please release the funds. The employees will not be paid this week unless you release the funds. Please grant my client a payment plan. Here's a financial statement. So you can do that. The danger of this scenario was telling the client to open another account to hide the money from the IRS.